It's starting the live stream now. It just takes a moment.
Maybe there should be like a bonus for people who are here in person.
I think there we go.
Okay. All right. Can I switch to my slides? Or do you want
So I'll go ahead and do an introduction.
Okay. All right.
Everyone on the live stream, do you see us? We're going. All right, I think it's working, so we'll just go ahead and get started. Thank you so much for coming out. We do these once a month. My name's Travis. I organize this meetup group. I see a lot of new faces here, so I'll kind of let you know what it is we do. We do these events once a month. We come out here, we pick a topic and discuss it. This month's topic is going to be on taxes. A very big thing right now in crypto is how do I pay my taxes? And I'll introduce our speaker in a second. First thing I want to do, though, is thank the location, Digital Garage. There's their helpers all around. If you can get a round of applause for them, that's really great. Excellent partner. And then I also want to go down our sponsors really quick, the people who made your beer and pizza possible. So Waxman PR, they're a PR firm out of New York. They do a lot with a lot of the big, crypto companies you probably have heard about. They have a good client list you can see on their website. They're a longtime partner, a longtime friend. CoinSource as well, about as long as Waxman. They do Bitcoin ATMs. So raise your hand if you do not have Bitcoin. All right. For those at home, there, I think I saw one hand. So that's pretty good. So I guess you won't need it, but if you want more Bitcoin, the CoinSource is a great way to get that. They have a couple ATMs in the city as well. Dash has also been a long-time supporter of community. We're a crypto community, and they've given us a lot of support and help, and I'm a big fan of any project that does that. And then finally, Curio Cards. This is actually a project that I'm involved with. It's sort of an experiment to find ways for artists to use the kind of new blockchain technology and get paid better and get treated better. And what we're really looking for right now is a bunch of artists to submit some artwork, and we're gonna kind of experiment with how to deploy that and have some fun with that. So if you want to check that project out as well, I definitely encourage it. Without further ado, the reason why you're here, I'm going to go ahead and invite up Alice Towns. She can go ahead and give her introduction, and we'll get started. All right.
Hi. My name is Alice Towns. I'm a tax attorney. I've lived in the city since 2013. I moved out here to be a tax practitioner and work with Silicon Valley entrepreneurs because they're more fun as clients. And this is the coolest project for a tax lawyer to be involved in. So this is really the nexus of what I'm excited about. So I'm really glad to be here. And as a lawyer, I have to start with a set of disclaimers. So remember, this presentation is actually intended to be information. That means it's not classified as advice. So I am not providing legal advice, and it should not be construed as legal advice or any other kind of professional advice, including investment advice. We'll get to that. So my goal tonight is to talk to you about how a tax professional would think about the current issues in tax and cryptocurrency. And I'll be considering a series of hypothetical facts that you will probably all be familiar with. But we're going to keep thinking of them as hypothetical facts. So please ask me questions starting with the word hypothetically. And I wanted to emphasize I'm not here to market my services. I actually have a day job at a large firm, and we don't provide advice on these subjects at my firm, and my current firm has not approved this presentation in any way. So don't construe this as a message that they've signed off on. So that's important too. Okay, so this is a hot topic. It's kind of exciting for me as a tax lawyer that people care about this so much. But I wanted to start off with brainstorming a little bit about what people are talking about right now. What do people care about with regards to taxes? And I kind of put together this list this afternoon. I was thinking to myself, what have I heard mentioned recently? And so on my list are Notice 2004-21, which was released in 2014-21, which was released in 2014, which is the IRS's only public pronouncement on taxation of cryptocurrencies. We also have people asking questions about how ICOs are taxed, Swiss foundations and their tax concerns, the Coinbase summons, currency treatment, the like-kind exchange rules, which I assume at least 90% of you are excited to hear about, the wash sale rules, valuation, how to calculate taxes, and fairness. And I work up to that point, fairness. So in the event invitation, there's a podcast that was released last Tuesday, and two tax practitioners spoke on that podcast about taxes, and they spent an hour going through all of the highlights, and I highly recommend it. It's really, it's going to go through topics that I am not going to talk about today. It's on the event invitation, the event page if you want to look it up. But one of the things that really stuck out to me in their podcast was they keep going back to the fact that people still are having trouble absorbing the fact that these transactions are taxable. And there's a sense, partly, a logical inconsistency there, that people are confused about why these transactions are taxable and they feel like it's unfair. And I actually wanted to focus my presentation on that point because Tyson and Jason last week, they did such a good job dealing with the broad set of ideas that people need to talk about when it comes to tax and cryptocurrency, that I really just want to recommend that podcast for that purpose. And I want to talk to you guys about how do you start thinking about a really gray area of law, and how do you actually struggle with an answer that allows you to file your tax return. And to me, that's a more practical approach because there's no way to address every question that you have on your minds. So if I give you the tools that allow you to analyze these issues, then you might be in a position to think them through and also ask your advisors the right questions. So fairness, to me, the fact that people feel like it's unfair is something I want to grapple with. So if there's something on this list that you're really excited about, we're going to have an extensive Q&A after. This is only a short talk so that you can spend most of the time asking questions. So keep that in mind and we'll get to it. Okay. So in order to convince you that there is some underlying fairness here, I wanted to start with what is our legal support for taxation, i.e. what is the structural system that we have in our system of government that allows for taxation to occur. Because this is new, right? It's like 100 years old. I remember tax lawyers celebrated the 100-year anniversary just 5 years ago. So we decided at some point that tax was okay and was fair. And how did we come to that decision? We all decided it was a democratic decision, right? It was done through the amendment process. And we said that Congress shall have power to lay and collect taxes on incomes from whatever source derived. And so that's now codified. You see section 61 of the code says the same sentence. All income from whatever source derived. And I wanted to start there because ultimately what that means is we are taxing based on income as opposed to wealth. So there are lots of ways in which you can tax, get your revenue. If you want to get revenue as a government, you can develop a taxation system that is not based on income. You can develop your taxation system based on wealth, land. You can base it on consumption. These are all tax systems that exist that are not actually being used right now. Our main source of tax revenue is income. And the reason why we start there is I guess at the nexus is why I think this is a fairness discussion. So why is income the right mode of taxation? The reason is that there's three main points here. One is that when you actually receive income, in theory that's a liquidity event, i.e. you have enough cash on hand to pay tax. You're not being forced to pay tax out of illiquid assets. So for example, if you had a land tax, you would have to sell your house to pay your taxes. That would be extremely bad. Our property tax system in California is incredibly averse to that. We think that's very unfair as a culture. So if someone's selling their house and you tax them then, that puts them in a position to pay that tax without necessarily making any different decisions. So you're not influencing people's economic decisions too much. Also, when you make a sale, it gives you automatic information about the value of the asset. So if you're trying to base your tax system on increases in value, a sale is the right moment because most people aren't sitting around doing valuations of all their assets. And the last thing is it's very easy to track. Okay, so money's transferring in and out of bank accounts, and 1099s are being filed, and all those things. Okay, so the reason why this is intended to be fair, the reason why I focus on fairness here, is that if you tax income, then people can make an investment decision first, and then they can pay their taxes second. And if you don't structure it that way, then the tax can begin to inform your investment decisions, your life decisions, and how you structure your investments, and that is not really a good way to protect your economy. You don't want tax pressure to direct people's decision making. And that also, really is part of my presentation today, is I want to make sure that people are not making decisions in their investments because of tax. It should be the second thing you think about, or maybe even after that. So optimally, there's a couple of exceptions I'll get to, but so anyways, so hopefully now we're actually going to talk about the real stuff. Thank you for being patient for that 5 minutes or what have you. So what does this get us to? So what's income, right? Income is when you receive, you sell your house for cash and you receive cash. You receive dollars in your bank account. But there's this phrase, from whatever source derived. And that means that if you received a piece of property for a piece of property, that's also income to you. And that's when you begin to strain the fairness concept. Because a barter transaction, i.e. an exchange of property for property, has no cash element. There's no liquidity. So you're going to be putting pressures on people, economic pressures on people due to tax that you did not want to actually put on people. However, if we didn't have a system where we tax barter transactions, everything would be a barter. We would just transact that way, right? So in order to make sure that transactions are, so generally speaking, I guess where I wanted to go with this particular slide is, generally speaking, barter transactions are rare, okay, in the outside world, right? We have, a barter that you might engage in casually with a friend. Sometimes very large companies do barter transactions. They exchange stock for stock. There's a few limited circumstances where we see a barter. And most of the time, the person who's engaging in the barter transaction is well-advised, well-equipped, and can pay taxes on that transaction. In the case of a stock-for-stock exchange, maybe you're not well-advised, maybe you're not able to pay taxes, but the code is full of exceptions for why a stock-for-stock exchange may not be taxable. Why? Because there's no liquidity there, right? We drafted the code to give those exceptions because we understand there's inherent unfairness in taxing a barter transaction. So, having said all of that, we are now in a world where people, many people, are engaging in thousands of barter transactions. What do we do? So conceptually, a barter transaction actually breaks down into two transactions. You have party A buying, selling asset X for cash to party B, and party A then buys asset Y from party B for cash. And if you conceptualize a barter transaction in those two pieces, the hypothetical transfer of cash, you begin to understand how this could be analyzed from a tax perspective. So that's the secret to a barter transaction. Think of it as two separate transactions, one where you operate as the seller and one where you operate as the buyer. And it happens simultaneously, so all of this is, erased in natural practical effect. But when it comes to accounting, this is the way to start thinking about the accounting. So that's barter. So obviously here it's a very similar picture, but it'll be even more recognizable to you, right? Because you can't exchange Ethereum for Bitcoin without two different addresses. So they are separate transactions pragmatically. So you can begin to sort of think about it this way for a crypto to crypto exchange. So I actually don't remember what my next slide is. Okay, good. So I wanted to leave it with this picture and sort of move on to why a lot of, what the question I'm getting the most often, which is like-kind exchange. So, like I was saying, there's inherently, the taxation of a barter transaction kind of breaks the inherent fairness of the tax system, right? So we have these exceptions for stock exchanges. The exception for two homes being exchanged for each other, or two buildings being exchanged for each other, is codified in 1031, which is the like-kind exchange rule. Historically, that has applied generically to property. Although the code has been that code section has been primarily relied upon for exchanges of real estate. Hi, Alan. Sorry, guys. They've been primarily relied upon for exchanges of real estate. It actually does include all other types of property, and you have to dig into a series of IRS regulations that have sort of basically driven down and shrunk the classes of exchanges that can qualify for like-kind exchange, and not just for real estate, but outside of real estate. And the reason why is that if you defer tax on a transaction, for a lot of people and for the IRS, that means they may not ever see that tax, right? So they don't want deferral. A like-kind exchange results in deferral because what happens is your purchase price for that piece of property, that cost basis, rolls over to the new asset. Whereas in a standard transaction, the cost basis would offset your fair market value, your amount realized, and result in the difference between your cost basis and the fair market value being taxed. So that's income to you from wherever source derived. So you provide an exception to that rule, and you say under 1031, your basis rolls over. That preserves the gain, right? You still have an asset with the same fair market value and the same basis. It preserves that gain in a new asset. So that's, as a technical matter, that gain someday will be taxed by the IRS, but obviously they don't want to wait, or they don't trust that it will. It could lose value. You could just sit on it for the rest of its life. It's like a piece of property. So it's not a good outcome for the IRS, and so they've been shrinking the classes of things that can qualify, and intangibles are the smallest group. So when you get down to the rules about like-kind exchange of intangibles, the closest analogy I can find to help think about crypto is a patent for patent exchange, because that's obviously the one we see the most often. Large companies who own patents will exchange them for each other. And when I say we see the most often, there is very limited authority, even in this, the most popular type of like-kind exchange for intangibles. The IRS has resisted taking it to court, resisted publishing advice. There are so many questions. Practitioners are asking so many questions about how to apply these rules that they don't even feel safe drawing a conclusion. And so like-kind exchange could apply to intangibles on a fact-by-fact basis. You have to look at your circumstances and determine if your intangibles qualify. And a patent, you're exchanging a patent for a patent. That's the same thing, right? Well, not quite. So you look through the patent and, oh, it's a pharmaceutical patent. It's for pain medication. Okay, done. They must be similar. No, the IRS wants you, in the little bit of the guidance we have for a patent, you have to think about whether you have the same customer base, the same manufacturing. It's so narrow that they have a list of requirements that are beyond rational. I mean, I don't think personally that having the same manufacturing methodologies for that patent should be particularly relevant to whether that patent is similar to another patent. But this is how far the IRS will require you to go to establish like-kind exchange in a patent case. So if you think about Ethereum and Bitcoin, right? They're both mediums of exchange. I think that's about as much as I can say about how similar they are. The blockchain is different. It operates differently. I maybe a very technical person could take that analogy further than me. What about a token for a token? What if you're exchanging Ethereum for a token that has a very narrow purpose, like to transact on a specific exchange that only handles one type of property? In that case, you would have a much more difficult time. I'm sort of trying to bend, I'm thinking of tokens that are outside of the class of a medium of exchange, but are beginning to be utility tokens. Then you would really have to think deeply about the factual circumstances to qualify for a like-kind exchange in a transaction between utility tokens and a medium of exchange coin. So that's kind of how you would think about it. Look through the actual thing that you're exchanging, which is cryptocurrency, and ask questions about the nature of the underlying rights and activities that it represents. So one of the complaints I've been getting lately is everyone's like, okay, you tax lawyers, you don't have your story straight. You're all disagreeing with each other. Half of you say you can get a like-kind exchange treatment for your transaction. The other half of you are saying not. So, and I appreciate that. But the reason why you're getting that kind of feedback when you talk about like-kind exchange or Google like-kind exchange is because the practitioner thinks it's extremely difficult to establish, has not seen the facts of their particular reader, and they are saying that if you take that position, you are taking a risk. And so this is where I want to start talking about how do you deal with gray areas like this in the law. This is maybe the most interesting one for everyone right now, like-kind exchange, but this is just merely an example. And when we think about tax positions, we think about them on a continuum from aggressive to conservative, right? And your personal preference on how aggressive you want to be in your taxes comes into this decision. And so there is a limit, right? You can't be endlessly aggressive. And actually, if you're a company publishing your financial statements, you're not allowed to be endlessly conservative either. That would also be a violation of your fiduciary duty. So how do you make a decision about how to apply a rule that falls somewhere on this continuum that isn't blatantly obvious? So what falls into blatantly obvious, and you probably would be treated as committing tax fraud if you filed a tax return contradicting this position? Well, I would including your W-2 wages on your tax return. If you fail to include your compensation from your employer, that would be patently frivolous as a position. Maybe you're a tax protester, and it would be probably tax fraud if you did it intentionally and you could establish that you did so intentionally. And the same goes for Notice 2014-21. What Notice 2014-21 does is it means that if you do not report your cryptocurrency income on your return, the IRS is now has an easier time arguing that you have committed tax fraud. That's what notices do. Notices do not say what the law is. They say the IRS can now make this argument. And they can say you had notice. So you should have known better. So Notice 2014-21 says transactions with cryptocurrency are taxable. All right, so those are all on the spectrum towards you can't even, too aggressive to take that position. That's not even aggressive, that's now either negligent or fraudulent. It sort of inches up from there, but the spectrum, we think about it from 0 to 100%. And actually there is no 100% and there really is no 0. The thresholds are 33.33%. This is literally what tax lawyers do all day, I promise you. 33.33%, 50.0001%, 70%, and 85%. And these are really important thresholds. And I'll explain each of them. So 33.33% is a substantial authority position. What that means is you're taking a position for which there is substantial authority that you can support that position on your tax return. And taking it to its full extreme, if you litigated in tax court, there is a 33.33% chance that you would succeed. Okay? That is not 100%, right? You do not have to be certain. That's a standard tax return position. That is probably where most of you would probably fall if you needed to make a decision on your tax return today. However, there is now, I also talked about 50.0001%. That means it's the kind of the favorite one. It's called more likely than not. If someone's come to you and tried to sell you an opinion on tax treatment, they're probably trying to sell you a more likely than not opinion. And the reason why is that if you are a business and you take a position that is at less than more likely than not, you're required to take a financial statement reserve, i.e., you have to reserve financially, you have to assume that you're going to lose in front of the IRS on that position. That's a really bad result for a business. It also is a 50% likelihood of winning in court, probably represents a threshold for most of you on how comfortable you would want to be on your tax return, right? Like some of you would say, I don't really like 33.33%. 50% sounds good to me. 70% is should opinion. So we said substantial authority, more likely than not. I notice you're shaking your head. What's up? You disagree?
No, I'm just...
So 70% is controversial, by the way. Tax lawyers argue about whether it's 70%. I was wondering if that was why.
No.
It is controversial whether it's 70% or not. So should is a level of certainty above more likely than not. That means that you're probably paying your tax lawyer a lot more to get a lot more in depth in the analysis, and they've written a lot more about it, and you're just that much more comfortable. Let's say you're the kind of person who likes paying your taxes. You probably want to start with a should level opinion. Okay, and will is the level that you want to be at if you're a large public company and you're making decisions. And if there's a will opinion available, if you can make a decision path where your tax treatment is at will, large public companies go that direction. So those kind of how we think about it. That's 85% certainty of success in tax court. So now you're thinking on a continuum between 0 and 100%. You kind of have a sense of why people try to hit these target numbers. And you're thinking to yourself, but I don't have the expertise to evaluate where I fall. And that's really tough. Individuals are in a really tough spot in this space. This is unheard of. The level of gray area that you're handling, I guarantee you that most individuals have never filed anything on their tax return that is below a will level opinion. Okay? Like, your W-2 or even your business deductions. You're probably doing things incredibly conservatively. Here you are, you're forced to make a decision, and it's very unclear. And so I think take a step back and remember where the IRS is standing, right? When they audit you, they want to make you into a good tax compliant citizen. So they are looking for good faith efforts. And I don't know, we'll talk about the nuts and bolts of compliance at the very end of my talk, but if you are showing that you are taking a good faith effort to attain a level of comfort that is reasonable on for your tax position, then it's going to be a different kind of conversation when you go into the meeting with the IRS auditor, right? So individuals are not sitting there thinking about substantial authority and should and will. They're thinking about, am I getting this right? Is this reasonable? And I think, like, practically speaking, that's how we're all going to be handling this tax season, right? So I kind of want to talk a little bit more about what that looks like. But I'm going to pause a second and see if anyone has any questions about what I just talked about. Go ahead.
Okay, I don't even know how to phrase this. I mean, you really got into sort of the weeds there. Conversation there.
Yeah, sorry about that.
So, no, I mean, it's good, but I'm sure there's a variety of level of experiences here and everything. So, hypothetically speaking, say it's an individual, not an employee, not a company in this arena.
Mm-hmm.
Say if an individual you know, got their toe into the arena, purchased some crypto, say, spring of last year, you know, modest investment, under 10,000, and left it in a custodial exchange, one based here in the U.S., and just saw, say, there, you know, this person does not use Bitcoin or any other to transact. They just put it on this custodial exchange, saw the valuation go up to 70, 80, then drop back down, of course, you know, at the end of, you know, the December or beginning of the January. Since that's still sitting in that custodial exchange, that person is not, you know, experiencing a gain, right, until they take it out.
Right. So, yeah, that's a good point. I will talk a little bit about, I'll just take a pause and work back and talk a little bit about like the pragmatic reality of what this, that you're referring to there. Because I think that's a good point. I did skip over that a little bit. So the question that she's asking is if you buy some coin on a custodial exchange and hold it, and keep holding it, and the price is going up and the price is going down, and you're watching, and you're just holding it, and you haven't sold it, what happens then? And I want to circle back to my slide on the income tax. So because we have an income tax, changes in value as you hold a coin are not subject to taxation. You have to make an exchange. But I want to go a little bit deeper there, because what if you transfer from Coinbase to another exchange or to a private wallet? That's still your same Bitcoin that you owned previously. So it can't be taxed, because even though it's been moving from address to address, you have not had an accession to wealth, that's a technical term. You have not received income. You haven't recognized the value of that coin. You have simply moved it from one pocket to another. But Coinbase will not have records of the fact that you controlled those other addresses. So bear in mind that Coinbase will report to the IRS on 1099. It's a very different story. So I want to make sure, though, that I leave some of the more detailed questions about compliance until after I've talked about compliance. So if this is a compliance question, nope? Okay, go ahead.
So does that potentially mean that a lightning channel that's open and not closed would be a permanent deferral of an accession to wealth?
So I think that's a great question, because it allows me to put more nuance on what I was just talking about. So lightning channel is, just for people who are not familiar, I'm familiar with state channels where two parties are expecting to engage in a lot of transactions. So they contribute to a channel, and both of them put in their initial funds, and that channel maintains the record of the different transactions that occur between the parties. Am I currently about correct? And then they can elect to remove the funds at the end with whatever balance they actually came up with. So that's I think that's really the counterpoint to what I was just saying about moving the Bitcoin from one pocket to another. If you set up a system like a lightning channel, you are still engaging in economic transactions, right, with a counterparty. So each of those would be taxed within the channel. Is that?
In a way, it's more like I put $100 in my jeans pocket, then I lay my tax for someone else.
Well, no. If you think so the way you've got to think about it is always take a step back and remember these rules were not designed for cryptocurrency. So we cannot analyze how tax law applies to cryptocurrency by taking it too literally. We have to take a step back and think about the principles. And one of the principles I'm trying to describe here is how people economically receive income. And the moment when you receive income is when an asset that you hold is exchanged with another party for value. Regardless of the nature of the complicated software development around it, or however you want to structure that transaction, if there's a counterparty and they receive your coin, you recognize the built-in gain. But when you contribute it to the Lightning channel, that's the pocket. Right? Okay. Am I good? You're like not happy with me. It's okay. I figured none of you guys would like me after this talk. So where I want to go to next was to talk a little bit about the nuts and bolts of compliance. Would you like me to proceed with that, or do you have something that addresses the prior point? Oh, sure. I can't hear you very well. Is there a possibility that we can get him a microphone?
Like the likewise exchange, or
Like
similar
kind?
product, like kind.
Uh-huh.
So I'm specifically interested in Ethereum and altcoins, since altcoins are just a software product that's technically run on Ethereum. You're not actually going from like network to network, Ethereum, Bitcoin, something like that. You're just processing a contract on the Ethereum network.
Right.
How does that function for like kind of exchange? Because it seems like you're not actually exchanging anything to anybody. You're running software. Other people are running software, and software interacts. And it never leaves Ethereum. Generally.
Don't take this the wrong way, but I'm actually going to throw a question back at you. Okay. As you're transacting between these different Ethereum contracts, right? Are you doing it in order to become richer?
Well, it depends on how the contract goes.
Exactly. So are you engaging in investment transactions that are intended to arbitrage between the value of those various contracts?
Well, you had mentioned earlier between like a token, a utility token, and a currency token.
That's a good point.
It could be a utility token. You could be exchanging it in order to use it for something.
So, two layers of inquiry, right? First is this transaction taxable? The second is, does an exception apply? All right, and so we don't think about like-kind exchange until after we determine it's taxable. So I was thinking of your question as is a taxable question. Assuming that it's taxable, right? The Lightning channel, taxable. Then we ask, is it a like-kind exchange? And then I need to know a lot more detail about the nature of those tokens. Are they utility tokens? Are they medium of exchange? You would, and this, I hate to sort of say you have to hire a tax lawyer, but this is probably one of the most justifiable reasons to hire a tax lawyer is because it's such a fact-based analysis. And what happens is that you can document that the facts meet the requirements in a written tax opinion and keep that in your back pocket. When the IRS audits you, your tax opinion is your defense. And it also protects you from penalties. So the like-kind exchange rules are unfriendly to intangibles. But they are there, and so I think it's really a personal preference on how comfortable you need to be to file your tax return, how much advice you need to get from a practitioner before you file it, and what level of authority they need to cite. So are they at more likely than not? Are they at should? So you can pay a tax lawyer to say which level of opinion they are at, and they will give it to you. So I don't know if that's helpful. Sorry, that's kind of dodging the question.
Yeah. Let me ask a follow-up question based on what you said there.
Okay.
If you exchange an Ethereum token for a utility token on Ethereum, so you use it for utility, right?
Mm-hmm.
And then the value changes so that when you're done with it and you go back to Ethereum, it has appreciated.
Yeah.
That's obviously a taxable event, I assume, or is it similar to buying a real product for some utility, and then when you buy the product, you're not necessarily paying.
Should I talk for a quick second about currency transactions, like dollars?
Yes.
Yeah, because I think that there's a little bit of a misunderstanding about how currency transactions are taxed when we purchase for dollars and use other currencies, and whether there is tax there, because it's not literally a barter. You're not exchanging two assets. We think of currency as different, but tax lawyers, they love intellectual consistency. So let me tell you something. Transactions using currency are taxable, except in dollars, because dollars are the mechanism by which we set value and by which we determine tax liability. Because numerically, we use dollars, we can't say a dollar appreciates in value. So there's never any built-in gain in dollars. It's just a accounting feature of our tax system. However, if you own any other foreign currency and you transact with it, it may increase in value, it may lose value, and those are taxable transactions. Companies that trade Forex, do Forex trading to make profits are paying tax just like a stock trader. But there's a narrow exception if your transaction is for personal use and it's $200 or less. Very narrow. And you can look into it if you're really curious. But I think most of you are probably not buying coffee with your cryptocurrency right now. You're probably doing the taxable kind of cryptocurrency transactions. So if cryptocurrency was a currency within the meaning of the tax law, there would be no difference. It would still be like a barter. So, and that, I don't know, that kind of was inspired by your question, but I don't know if it really answers it, and I apologize. We can also talk afterwards if I didn't get there. So, but I wanted to talk a little bit about the nuts and bolts of compliance, because ultimately a lot of people's compliance obligations for tax has been very simple. And I'm sorry, I don't know your name, but the lady with the white hair, your question, I really want to bring people like you back into the conversation. So most people have very straightforward tax compliance. Their employer withholds all the tax and they file and they actually get a refund, and it's fun, right? So when you do that, what do you use? You use a piece of software, a website, and you input a few things and you submit it and you get a check in the mail a little while later, and that's your tax compliance for the year if you do it at all. And if you run a business or you are a self-employed and you have a lot of self-employment income, you've probably begun to dabble in the more complex type of tax compliance. If you're older, you probably have owned a home, you probably had more complex tax compliance. Then you're hiring an accountant who files a tax return for you, and they're definitely charging at least $1,000 per return. So the number goes from $50 for your website to $1,000 pretty fast, and then obviously once you start saying words like Bitcoin, it gets even higher. So when people ask me, how do I file my tax returns? I have this refrain I always say, you're not a special snowflake. Just use the website like everyone else. Most people are sitting there thinking, really? For this stuff? This stuff is crazy complicated. But it's really just a massive amount of data, which boils down to a lot of transactions that end up on a very simple return, which is your calculation of your capital gain. And what's difficult about tax compliance in this space is the volume of data. I mean, ultimately, for most people who called me freaking out, it's the volume of data. And so this is literally a spreadsheeting exercise. And what practitioners are beginning to market themselves as providing is the calculation. Because you can feed that into any old tax return preparer system. You can even give it to your old favorite accountant that's been filing your tax returns for years, if you can do the calculation and someone can provide you the calculation. So the problem is the data output from the exchanges, right? So the exchanges are not giving great data. They're giving bad information on value, but even more importantly, they're giving bad information on basis. So the most dangerous area for calculating your taxes is your purchase price. And that's partly because they may not have information. Let's say you moved it from one pocket to another, from one address to another. But it's partly because there hasn't historically been a very strict requirement that an exchange or someone similar, like a stockbroker, maintains your basis for you. And the reporting requirements for basis are brand new. So they're still learning about how to calculate and how to maintain those records, and they're not really being forced to do so. So you actually have to trace your transactions that way. Are you going to tell me what time it is?
Yeah. Oh, no, you're fine for now. I actually have a question from the live stream about what you're talking about right now in regards to what the exchanges are saying, what they're doing.
Yeah.
Can you clarify what happened with Coinbase in 2017 when what information they gave the IRS?
Oh, but that's a really separate topic. I will talk about that for 5 minutes at the end, if that's okay. I just want to talk about compliance a little bit more. Yeah, I saw that. I'm sorry, guys. I was supposed to be really short.
You're fine.
So the compliance hurdle with the data. I think that the people can grapple with the data and figure it out on their own if they feel comfortable, or they can hire a practitioner. But it really is about comfort level again. And I don't think that this feeling of immediately thinking I need an expert to tell me how to calculate all these transactions is necessarily where everyone needs to go. I think that if you look at it and you feel like you can understand that your 5 Bitcoin transactions last year were related to Bitcoin you purchased at X dollars and you sold for value of Y dollars, no matter what, then you're probably sophisticated enough to figure out what your tax liability is. And the danger, okay, go ahead.
What about airdrops?
Oh, so airdrops, that's a good question. That actually was covered really well by Tyson and Jason in their presentation on Unchained last week, the podcast that's in the link for the meetup. I recommend it. I actually styled this presentation not to be directed towards business people and more towards individuals who are trading, but
Traders got airdrops too.
yeah, traders did. I was about to say that doesn't. So, can I reserve that to the end as well? I just want to get through this section really quick. Okay. So really all I really want to get to, and sorry, just quickly, is that when you think about your tax compliance, right, the risk is that the IRS is going to disagree. Right? What are they going to disagree with? They're going to disagree with the amount of tax that you owe, and they're going to say you owe more. If they don't think you owe more taxes, there's no tax due, there's no interest on that tax, and more importantly, there's no penalties. So if you get to the right amount of tax in a given year, you're done as far as the IRS is concerned. They may argue with you, they may ask for documentation, but if they can't assert more tax, if they can't find a justification for more tax, then you are okay. So that's if you think about your overarching guiding principle with your tax compliance, is you need to get to the right number, right? Documentation is the way you get to that right number, and it's the way you establish that you took, you did your best, you took reasonable procedures to get to the number, you maintain your spreadsheets, you keep them in a file, you do not delete them for 6 years, right? But the starting point for consequences for failing to comply with your taxes is owing more tax. And I feel like that sounds really dumb to people, but I actually have to explain that. Sometimes people are calling me and they're freaking out. So what does that mean? If you engage, let's say, the simplest fact pattern that I want to exhibit this with is, let's say you bought your Bitcoin in January. You engaged in like 1,000 transactions with that Bitcoin, right? But then after all of those transactions have occurred, with all of those altcoins, shitcoins, tokens, whatever's, you sold it all for dollars in December. Remember about the idea of basis? So every transaction you establish basis. You generated taxable income, but then you established a new level of basis. Then you lost money, obviously. And then you established some loss. You established a new basis, slower again. So every transaction that occurred during that year quantitatively generated its own little piece of loss or a gain or loss. But it has to add up to the difference between the value of the Bitcoin you bought in January and the value of the Bitcoin you sold in December. So if you're going to back into the right number for your tax and prove out that your huge spreadsheet is correct, it's pretty simple, right? So I wanted to give that idea, put that idea in your heads, because I feel like it demystifies it and makes it less scary. But that's all I wanted to say about compliance. Sorry. Can I do airdrops really quickly, because he asked? So the airdrops thing, it's actually, I think Jason and Tyson are quite right in saying that there's a lot of ambiguity there. And when it comes to like a hard fork, that there could be a possibility you could argue it's not taxable, but you have to think it through. But the airdrops is much more obvious. So airdrops functionally, I mean, you look at the facts, right? But functionally, the airdrops that I'm familiar with require people to participate in a vote or do something to get access to that airdrop. When you do that activity, that services you're providing, that's ordinary income to you. So the airdrop at the time it occurs would cause you to recognize ordinary income in the value of the airdrop coin. and then you would establish a basis at the fair market value that you pay tax on, and then you later sold it. It would become a capital asset, and you would sell it for gain or loss later, as you would other crypto.
So you think that should be taxed as income?
So fact pattern 1, right? That's where you're actually participating in some kind of service, or you're interacting with the community. You're doing something to earn that airdrop. I've heard of another kind of airdrop. My boyfriend tells me his Ethereum address has like all these random tiny things. That presents a compliance problem that is incredibly difficult to overcome. And that would fall into the category of situations where you really just need to take a reasonable approach. And the reason why I think it's a really challenging situation is not just the volume of information, but there's a value problem there. Those coins probably have almost no value, and if you could establish a value, where are they being traded? What's the authority? What's the IRS going to say they're worth, right? So Jason and Tyson, I think, if they get that fact pattern, the shit coins that get dropped on Ethereum addresses, they probably would say that kind of situation is sort of more like the hard fork, where you get a basis of 0, but if you ever sold it, you'd recognize all that gain.
Hard forks are not income there.
So and I agree. I think, again, not legal advice, this information, but I think that the hard fork position that they're recommending, though it's very hard, there's no authority and support for either position, but that hard fork is not a taxable event, because in the moment of the hard fork, you haven't done anything, and it is born from 0 to nothing in your hands. And as an accounting matter, you would have a 0 basis, and then you would later sell it for gain.
If you had to make a guess, when do you think the IRS is going to come up with guidance on more complicated?
That's a really good question. So you can force. Sorry, I forgot that you don't have a microphone. He's asking when the IRS is going to come out with guidance on the issue.
I'm asking you to guess.
Guess. So when can you force the IRS to come out with guidance? If the IRS decides to fight anyone and they take it to court, right? That's 3 years to audit, 2 years to get actually through all the procedures to actually get to the substance of the issue in court. Probably looking at at least 6 years for a court decision, right?
So it's too late.
So if you force the issue in court, that's the path, right? The IRS could also provide you with guidance. I got to tell you though, the IRS is kind of busy right now.
Sure. Nobody's in charge.
So they really just want to. They're going to start the way the SEC has. They're going to look for the bad actors, like bad guys, and they're going to go after them.
After one big target, and the rest of us, if it takes more than 3 years, then we're scot-free because it's too late for them to come after us.
There's a special rule for tax lawyers. They're not allowed to advise on audit risk for a reason. because the chances are really small.
I'm just asking about regulation.
Yeah, no, it's true. So there's a statute of limitations, but statute of limitations doesn't necessarily apply if you commit fraud. And so be aware that the statute of limitations of 3 years. First of all, it starts from the date you file your return, not from the end of the tax year. Exactly. If there's no guidance, but if you did something that was so obviously inconsistent, and the thing about fraud, and the thing about the thing that the SEC is going after is you know you're a bad guy. You know you're committing fraud. And I think that people are really scared because they think that there's some idea they could accidentally commit fraud. And I always think, I think that's a pretty funny concept because
but there's a huge difference between claiming it as income versus capital gains. So that seems like it's definitely a gray area with airdrops.
Oh yeah. So services income.
Because you got to do work to do it, but you're not doing work for someone else.
So yeah. So when the IRS looks at a tax return, right, the worst thing you can do is have no trace of that transaction on your tax return. If you report it but you characterize it wrong, then that's a pretty good step towards doing the right thing.
So what year do these airdrops?
Oh, I'm so sorry, guys.
Okay, so take.
I don't think there's
cash, for
a way to
example.
think about it. I don't think you're ever going to get an answer, to be honest. If you're waiting for one before you file your taxes this year, that's certainly not going to happen.
Because I'm pretty sure my accountant's going to ask me what.
Right. And you're going to say to your accountant, I'm paying you to be an expert in this accounting, and so I need you to analyze it for me.
You obviously haven't met my accountant.
Yeah, so accountants can be a little thorny. I work with them, so I appreciate that. But their job is to apply broad principles to novel issues, right? Just like lawyers, accountants have to do that too. So if they are saying, I don't want you to be my client, that's one thing. But if they're asking you to do the analysis for them, then that's a response, is that they need to figure it out.
Hypothetically, if you were my tax lawyer, would you advise me to claim the Bitcoin cash income in 2017 or when I sell it, the year that I sell it?
I'm very glad that I have not actually been confronted with that question in practice yet. It's a difficult one. I'm actually a very conservative person as a practitioner, and I would probably counsel you that you would be almost at the threshold of being, I think you would be below more likely than not on that, only because that's where, I guess I haven't thought about it fully, and I would need to do a lot of thinking, but I probably would say you're between that 33.33% and the 50% on that, and then I would tell you, you don't want to document an opinion that below 50% probably, so you probably would just need to make a decision on whether you want to take that position. So that's where I would be. But that's only because stock splits, there's a reason, there's language in the code that, enables a stock split to be protected, right? But we don't have language for this. And that doesn't mean that you're scot-free. If you don't have language, that probably means you're worse off.
Also, you could argue that you were not aware of your airdrops when they occurred. I mean, it's a lot of work to keep up with them.
I've heard that. Sorry.
I can carry the mic over.
Does the existence of futures for a hard fork determine whether or not there could be value when the hard fork occurs?
Okay, so the question that we have right now is if there's a future, does it help you establish value? I don't know of anything that's not being sold for dollars that has a future. But here's how you'd have to think about it. So valuation ranges from exactly what everyone is buying for dollars, like a stock on the New York Stock Exchange, right? To something you pay $100,000 for from a specialist who runs a huge number of calculations and says, this is our estimate of what this is worth, right? Valuation is not an exact science. So whether you as an individual filing your tax return have the resources to determine value, I think is a fair question. And so if you're looking at a future and you're saying, okay, I think I can see that, and this gives a dollar value because someone bought this future for dollars, and I can extrapolate to the value of it today, I think that's a mathematical exercise, right? It's quite complicated. I don't think that that's a reasonable thing for an average person to do. But if it's being sold for dollars on Coinbase, then you know the value, and I think everyone's pretty comfortable with the value. But if there's like 5 exchanges with like vastly different values, you have to take a reasonable approach. And you're not expected for a $10 transaction to go and hire a valuation expert to do a full valuation. It's a complicated issue. It's one of those areas where it's best efforts,
The mic over here.
So it goes back to your example that you said, when you buy a Bitcoin, then you transfer it and you do like 1,000 transactions.
Mm-hmm.
So once you do that over the year, so you're holding all these different coins at the end of the year. So at this point, you have to pay taxes on all those transactions that you're making? Or, like, for instance, if you don't sell any of the coins, you're just holding them, do you still have to report the taxes, or you can wait 2, 3, 4 years and then sell the coins and then pay taxes then? Or do you have to do it every year?
So that kind of goes back to your question that you were asking in the beginning, is like if you buy something and hold it, is there a tax consequence? And I'd like to sort of revisit the concept that you have to actually have a realization event, actually is a technical term, a transaction, to realize income and to be subject to tax consequences of any kind. So, but to go to your actual specific example, that hypothetical individual would have engaged in a transaction where they exchanged their Bitcoin for tokens at the beginning of that story, right?
Right.
So that's taxable. But the tokens themselves.
So but they never cashed out anything. So what's taxable?
The transaction where you exchange the Bitcoin. If the Bitcoin changed in value, right? You purchase it for dollars, you hold it for like 5 days, and then you exchange it for tokens. That fluctuation in value during that 5-day period, the difference between your purchase price and the value on the date when you bought the tokens is either taxable income or taxable loss, or tax loss. And it would be, bear in mind, short-term capital gain, so that's not a favorable result. But hopefully the fluctuation was small.
Next question is over here.
Hey, thanks for this, by the way.
Yeah, sure.
So hypothetically, or realistically, if I sent Bitcoin to an exchange in December and traded it for Bitcoin to USD, and then had the exchange wire me USD to my bank account in January, which of those events are taxable and when?
Yeah, so this goes back to economic reality and it being somewhat separate from how we perceive like the dollars in our bank account. It's the transaction when you sell it for dollars, even if it's held on an exchange. That is the taxable event. So the December, I believe it was December.
And then are the fees of the international wire deductible?
So the transaction costs are either capitalized into your purchase price when you acquire, or they're reducing your amount realized. But that's actually a really complicated question. Transaction costs are complicated. The short answer is you should not have to pay income tax on an amount that went to expenses. But I think it's maybe Jason and Tyson talk about it a little bit, and I think their answer is probably the one I would point to.
Okay, thank you.
Yeah, I write opinions about that stuff, so I can't answer it simply.
We may not have enough time for all the questions, but I just found out actually that Jonathan right here, he's a tax accountant who's doing a lot of Bitcoin as well, so you guys might ask him questions after.
Oh, that's so great. I have a chair for you. Yeah, sure. So are you a CPA? That's so cool. So
well, yeah,
lawyer, and now you have someone who does the other thing.
I've done personal income taxes for about 4.5 years, and tax policy for about 3. So we're on different sides of the legal divide. So I do not have to come with a disclaimer sheet fully. Well, I do, but it's different.
It's a different one.
It's a different disclaimer, so feel free.
Yeah, so tax policy, does that mean you are lobbying the government for change?
I worked in economic development organizations in DC, dealing with international taxation questions, moving things across boundaries, who does what where.
Oh yeah, so those are
expat
the big. You get paid by the Apples and the Googles. Yeah. Okay, got it. Yeah, I also get paid by the Apples and the Googles. So you're right. There's not a lot of money in tax law unless you're working for really large companies whose transactions are just astronomical. Sorry. Where's the microphone?
Oh, right over here.
Yeah.
So hypothetically, let's say in 2017 you bought Bitcoin at $800, let's just say, and then you squirreled it away into a paper wallet, didn't touch it until, let's say, September. You buy some more Bitcoin, and then let's say it's at, I don't know, 10,000. I don't know how much it was at. And then you sold it at 11,000. How does that whole situation get treated?
So the question I think that you're trying to highlight is how do you handle multiple tax bases? Yeah, and I had a theory about this back in 2014 that I tried to pitch people on. I don't want to know if I want to launch into it. There's Yeah, you combine the tax basis. In your story, you have easy facts, right? You sold all of it at once.
Oh, no,
right?
no, I didn't sell all of it.
You sold part of it. Okay.
Part of the one that I purchased later on. That's
Yeah.
a higher price.
I'm gonna answer. Yeah, so I'm gonna answer this question with a disagreement from Tyson and Jason, if that's okay. I like I said, their podcast is amazing, but I really don't agree with how they came out on this one. So in your fact pattern, you control the address.
Yeah.
So you know which coin you sold. I think in that fact pattern, you would, and I don't know how you fall on this, because I think this is really a practitioner by practitioner matter, but if you actually know which coins you sold, you have to offset it with the basis of that coin. If you use Coinbase, you know it dumps it all into one account. So that's a tracing problem where you have activity. And there you'd be allowed to actually pick and choose what you sold.
Yeah. Specific ID, yes. So you're allowed to pick.
So you should mix your coins?
Well, so this is one of those things where tracking basis is complicated even just for J-Day stock traders, and they have wonderful systems and computer models to do this for them. In your example, the IRS assumes that the day that you purchased it, you wrote down somewhere, either on an Excel spreadsheet or a piece of paper or in the recesses of your mind, what you paid and the exact number which you paid for. So if it's 500 coin for X price, that's what you wrote down. And then when you sell them, and you bought a second tranche, second group of them, that second group was also tracked at X number of Bitcoin at X price. You may elect to choose, and the IRS gives you the freedom to choose because they don't want to go through the transaction receipts, and they frankly don't care. They just don't have the time to elect what was you have what's called specific ID. You get to pick this group here was the ones I purchased at this price, and this one's the ones I sold at this price. And you can organize them that way. Excel is very useful at this. I think Coinbase spits out you a CSV file, and anyone with magical macros can run these things, and they're much more savvy than I am, but that's basically what you're supposed to do. You're supposed to track it as you do it. So I always tell people switch the name Bitcoin from Bitcoin to like Campbell's Soup Company stock. If you just change the name to some sort of stock, it's much easier for this investor, that they're just a casual investor, to think of it that way, because that's how the IRS is approaching it.
I just want to say thank you for the shout out to Excel. So I use Excel all day long, and my boyfriend is a software developer, and he insists on using the Google Sheets or whatever. Please, if you're doing complicated calculations, you can. So here's the thing about Excel: if you're a software developer, you understand. You can Google and get the exact macro or the formula you need to do what you need to do in Excel really easily. Google Sheets does not translate. So I know it sounds awful to like talk about a Microsoft product, but please, if you're trying to use Google Sheets and you're not getting there, that's why. Yeah. But thank you. It's so good to have someone else back me up.
Excel is just the name of the beast. Unfortunately, it's a legacy accounting technology. It's been around for so long. You're welcome to use Google Sheets, like you said. Just make sure to recognize a lot of the complicated macros and calculations. Google Sheets. Google doesn't make money off of the sheets. It's just theirs. It looks pretty. It's nice window dressing. It's not what they make money off of. So just recognize there are limitations to those sorts of technologies. And as always, consult a tax professional.
Yeah. Where are we at?
Next question.
That was my question. So I'm going to let the gentleman first.
I don't need the microphone, I don't think.
From your previous slide, you mentioned that which is the basis for keeping tax. I just wanted to clarify that if at a certain point exchanges were hard to get on, and so like say you had a friend who was like, oh, I really want to buy now, but I don't have accounts in these places, and you made a purchase on their behalf, and then had an exchange for the same amount by which you purchased, is any of that taxable at all? Or needs to be reported in any way?
So that in the fact pattern you describe where it's a friend, like actually a friend who trusts you, you're acting as their agent. So I think it would be probably an argument that it's their tax consequence the whole way through, and you would need to document that, and you would probably, if your friend is your friend, you need to make sure that they're paying tax and they're treating it that way, consistent. Again, this goes back to maintaining good documentation to prove that you had good faith intentions and that you were doing your best to comply. This is going to be very confusing as a paper trail to the IRS. So, you know, and 6 years literally before you actually have this argument. So write it down. Like, have your Excel spreadsheet, but also have like a Word document open where you're typing like, this is what I thought, and this is what I did, and this is why. And like, if you write that down, you will be thanking yourself later because you will not remember what each of the columns are in your spreadsheet. But yeah, I think it's just you're an agent. You're acting on their behalf.
Like email them so you have like that paper trail.
Yeah.
I would make it very clear. It's like, hey, I'm doing this, I'm buying this on your behalf. It's the same thing as if you went to the store and you bought groceries for your friend. And you know, you're going to send them a Venmo request and say, hey, you got to owe me $200 for the groceries. Maybe they're really fancy and they get all the special stuff. You just need to know it's like that's not your asset. Once you've transferred it over, it belongs to them. You're done. You've washed your hands. The tax bill is not me. It's not my social security number. No one's chasing. That's your responsibility. Your kettle of fish. So just make sure you have that there.
Yeah. Sorry, I was yelled at for not giving you the mic, so you do need to use it. It turns out.
It's easier for the live stream.
Absolutely.
Yeah.
All right. Next question is in the back.
Hi. So let's say there's a situation where you buy Bitcoin at $100 in January 2017, and then you start.
Oh, hi. Sorry.
No problem at all. So it's sort of like a simple transaction where you sell that for then, let's say $100,000 at the end of 2017. So all contained in 1 year.
Yeah.
But you actually can't get that US dollar out of the exchange because let's say the exchange goes down, or maybe there's some like withdrawal limits or something like that. So
I think that was his question.
Oh, is it really?
Yeah. I mean, you're talking about a more painful experience, right? What you're saying is this felt unfair to me.
Well, so the capital gains tax in 2017 is pretty clear.
Yeah.
But if you can actually get that money out of the exchange, you still have to pay that capital gains, and you know if you pay that capital gains tax, and then you end up losing that money because the exchange goes down forever.
Sorry, you got your coin out of the exchange?
So you transfer your Bitcoin to US dollars on that exchange.
Yeah.
But the US dollars are still sitting on that exchange.
Right.
You didn't actually withdraw them to your personal bank account to pay your taxes.
Yeah.
And the exchange goes down, right? So say like Kraken, for example, right?
Yeah, it's a really bad situation, but unfortunately, the economic reality is that you had an accession to wealth when you sold it. So, if you literally lost access to those dollars, Jason and Tyson talk about this. I think there are arguments you could make to say that you have a loss,
Worthless.
and then well.
I mean, it's
a hard target.
It's a hard target to hit.
Yeah,
in like a standard transaction, that's worthless. If it's a completely irretrievable asset and there's no way conceivable you can get it back, it's considered a worthless asset, and you get to deal with those laws that they have there. The IRS is a very wonderful definition of worthless. Is it conceivably retrievable? I can conceive of lots of stuff. I can imagine lots of things, and I can guarantee your auditor will be very imaginative.
Yeah.
So it's a hard target to hit.
Yeah, and I also want to add, there's actually like about 3 or 4 different ways to deduct the losses. You can treat them in different ways, and one of them got taken away in 2018. And I didn't mention this earlier, but like-kind exchange also gone, right? So just in case you missed that, it only applies to like real estate now.
Yes.
So yeah, so that long conversation we just had is only useful for 2017. And there are other hurdles too. You have to follow compliance requirements. You have to report your like-kind exchange. If there was any delay in time between the transaction, there's actually a requirement that you do paperwork to identify within 45 days of the like-kind exchange. There's all kinds of stuff. So like-kind exchange, definitely an area to talk to a practitioner about or think deeply about before you take it. Actually, I had a really cool point about like-kind exchange that someone made me think of today. I want to go back to. Sorry, I'm excited about tax. I hope you're excited about tax. So this guy goes, do you get to elect into like-kind exchange? That's a really good question because actually you can't. It's if you actually engage in a like-kind exchange, you're required to have a non-recognition transaction. That's how the code operates. And I've actually had to apply this in practice. I've had to think about this. You just sometimes do not want a like-kind exchange. More often, you don't want ambiguity, right? So the question is, okay, holy shit, so maybe I do have a like-kind exchange? I can't just conservatively pay tax? The IRS might challenge that. What if I have a loss and I want to take that loss? Is the IRS going to challenge my loss? And what it comes down to is you have to think about it from the IRS's perspective, right? If there is a position to take, then an intangibles exchange for another intangible is a like-kind exchange. They do not want to litigate that point, because they do not want arguments out there in the public domain that people can use. Because 9 times out of 10, it's a profitable transaction. The IRS is losing money. So the IRS is going to be put in a position where if they argue that you had a like-kind exchange, they provide an argument for all of the other taxpayers taking that position on gain. So logistically, aside from all the things I said about it being extremely rare for intangibles to be like-kind exchange, logistically, think about it from the IRS's perspective. They do not want to take, if you refuse to settle and they refuse to settle, they would go to court and they would have this paper trail where every taxpayer who wanted to take this position could point to and say, this is the argument. And anyways, so
it would be the Tax Lawyer Employment Act is exactly what they would have done, because
yeah,
she would suddenly become very, very busy.
There actually, it's a good point. There actually are specialists in controversy. So as some people in this space begin to experience audits, there are specific tax lawyers. I'm a transactional tax lawyer. If it gets any more narrow than that, I'm actually a transactional tax lawyer that specializes in very specific kinds of transactions. But there are people who are tax controversy lawyers, and they have a very special practice, which is negotiating with IRS agents and representing you in front of the IRS. And they are also, it turns out, accountants can also represent you in front of the IRS in those discussions. So those practitioners, they understand like this crazy language of negotiating with IRS agents. So I'm told. So the issue is educating your IRS agent. That's what my impression of the process, which I have no experience in, is that you have to educate your IRS agent, and it's incredibly exhausting and frustrating to educate your IRS agent. And that's before we talk about cryptocurrency, right? So those guys are gonna have fun. But yeah. Go ahead.
So if you purchase Bitcoin for Bitcoin Cash and then you sell your Bitcoin Cash, is the cost basis for the Bitcoin Cash the original Bitcoin purchase price, the price of the split, or zero?
You don't really get to have it both ways. So your position that you take regarding where the basis goes needs to be consistent with your position regarding the tax. But no, I'm saying, so broadly speaking, assuming blank slate, that there are alternative positions. Oh, by the way, yeah, you can decide. You're filing your tax return, you can take a position. And you need to determine for yourself what that position is. So yeah, you can decide. So a stock split would result in the basis being spread out in certain ways. You can use that analogy. But here, I think the more cautious position, if you're going to take the position which I like, which is at the date when it's born, it has no value and therefore it has no tax consequences, then the tax basis is zero. So I think that's the one I like. Actually, I take back before when I said I was less than 50%. I think you say that you have tax basis of zero because when it's born, it has no value, that very split second, and therefore you would leave all of your basis in your Bitcoin. So you would have to sell your Bitcoin to experience the benefit of that basis.
You can't move the Bitcoin. So how do you determine which of the coins is the true coin that your original purchase was for? Because people on both sides will claim that they have the original coin, and that the other is some kind of fork. Like, does each fork of a coin, each hard fork or soft fork, constitute
I see
zero return to basis?
I think that isn't there like actually a logistical reality there though, that there's one the minority report that maybe they begin to become more significant over time, but they start off as a minority report. That's how it functions, right? I don't see that movie. You know what I mean? Like They're like there's like a subset of exchange of miners that will transact using that coin, right? And they like slowly that number will increase. Am I correctly describing it?
Longer chains
I doubt the IRS would use that metric.
But yeah, again, think about always take a step back and be like, I need to explain this in terms that an IRS agent is going to understand, and they are
all the IRS
they have to be educated.
Sorry.
Sorry,
Yeah,
go ahead.
all the IRS is going to see is that there's a new asset that you have economic control over. That's all they're going to see. They don't care if you found cash on the street or just fell into your crypto wallet. That's irrelevant to them. What they're going to see is that all of a sudden some new asset that can provide you economic value has become available to you. Now, if you sold it right after you got it, then you're going to treat that as ordinary income, irrespective of capital gains. Your basis is going to be zero. For me, and I agree, it's more likely than not the basis is nothing because you didn't do anything to get it; it just happened. So, but just like as if you found $100 in the street, the basis of that $100 is $100, and it's $100 of income taxable to you. So that's how I would treat it.
If you move the basis over, the IRS would never catch you.
You are welcome to take whatever position you want.
Yeah.
I encourage you to take whatever position.
I
won't sign your return. But
that's exactly that's how tax lawyers and tax accountants talk. They say like, okay, will I sign your return? They will advise you. They will recommend the best process. But if you get someone to actually sign your return, they have to agree with all of the positions you're taking, and that's a much more strenuous exercise. And that's that's why I think that breaking this up into having someone process your data for you and then you filing your tax return is a more manageable process, because getting someone to sign a return with all these cryptocurrency transactions is much more expensive, I think. But yeah, do we have some folks who haven't asked as many questions?
Yeah, I think what we'll do, because we have more questions than time, I'm going to do 2 more questions. This gentleman here and this gentleman here, they have their hands up alongside, I believe. And anyone who still has questions after, maybe you can catch one of our speakers' attention for a moment. But we'll go ahead and shut down after these last 2 questions.
Thanks for the talk. Hopefully you can take another question on airdrops. Suppose you have this one case where all you qualified for getting an airdrop was that you staked a coin. Let's say you held 100 tokens of token A and you got 50 tokens of token B for just doing that. Is there any sort of way to figure out what the basis was? Is airdrop a taxable event? It seems like you said yes.
So it's the same coin, right? You're airdropping the same coin on top.
No, it's a different coin.
Is it brand new?
It's a brand new coin.
So what's the value? Does it have a value yet or no?
It doesn't have a value.
It
starts getting traded.
So it can be a taxable transaction and not result in taxable gain, right? So the story would be that you receive something with no value. You got basis of 0, right? And so you hold it as a capital asset. Yeah.
So it's taxable at sale? Is that
exactly? If they drop something that exists and is being traded, then maybe we would be talking about the question of whether it's ordinary income to you. Staking, proof of stake coins, that's a service in a sense. So I think it'd be really difficult to argue that you weren't receiving ordinary income.
So earlier on in the talk, you said that you buy a coin on an exchange, and then sometime during that tax year, you transfer that out of the exchange either to a different exchange or to a hardware wallet, whatever. Coinbase will report that as a taxable event with whatever appreciation as tax, profit or loss.
Yeah.
So does the taxpayer need to declare that the destination address belongs to an exchange or yours? But there's a catch to it, right?
Yeah, okay.
Assuming that you transfer out when there is gain of $100, that Bitcoin is now on your hardware wallet. Someday, if Bitcoin goes to the moon, it becomes $1 million. Where is the tracking for that? And is IRS going to force people to declare ownership of specific addresses of different assets?
Right. So I like a lot of this question. So first part is there's a lot of little like rows on the Schedule D where you report your capital gain, and then the attachment form which provides more detail on your transactions. But you're not required, because I would be strained to find a tax practitioner anywhere that would expect you to put your actual address on there, because the address is actually not material to whether you control the coin, right?
They don't need to know that.
So you may not even need to disclose like too much detail at all. It's a capital asset you transacted with. I mean, corporate taxpayers can say things like various.
Yeah.
Individuals,
yeah, and you can say it's various.
So that's part of your question.
There was some talk about making non-disclosure of ownership of the assets private. So you moved your
under tax law or under a new
$10,000 limit.
Yeah,
so
that's Treasury Act though.
So wait. But if that law has not been enacted, it's not supported by there's no support under existing law for reporting ownership of assets to the tax to the tax authorities. Okay, there's probably rules under other laws, but tax law does not require ownership to be reported. So until that law is enacted, there's no obligation. You're asking a different question though, right? You're asking, is it going to help me avoid the IRS hassling me if I give them this info, right? And that's a question everyone should be asking. That's a really good motivation because I can hear the Coinbase fact pattern. The Coinbase fact pattern is the perfect one. But let me tell you this. So up until about a year ago, every stockbroker reported 1099s without stock basis in them, and so people would get letters from the IRS saying they owed full gain, even if it was a loss. So the IRS is very used to seeing situations where they have bad information about basis. That's going to be an analogous situation to when you're moving between different wallets. So it's a matter of just maintaining your internal documentation and providing it upon request. So that's sharing. I think you're shaking your head, right? Oversharing sounds really good if you're scared, but if you're doing a calculation right and you keep all those records, the only thing that's going to happen is you're going to get a request for that record and you're going to share it later, and that's appropriate. That's the way to handle it. So yeah.
The best thing in this, just to close it out, in any terms of transaction or asset valuation or when you buy or sell a thing, the IRS has a good faith effort. You have to at least try. And if you try and you're consistent in your application of your method, even if that method may be very aggressive like certain persons in this presentation, or some people who are very aggressive forward persons, some people want to be a little bit more conservative, as long as you're consistent in your application, you were clear as like, hey, I have this asset, I sold it, I'm not entirely sure of the basis, but I'm going to try. Right. What's the worst that can happen? They're going to send you a love letter with a black eagle in the upper left-hand corner. They're going to want to talk to you. That's it. And that's, as long as you try and you show good faith effort, you can't get tried for fraud. Now, if you try to hide it, if you think you're going to outsmart the IRS, good luck. Good luck.
Just to be clear, there are penalties of up to 40%, so these numbers are going to be really significant for people who are actually not paying taxes on any of their transactions. So to get to 40%, the IRS has to feel like you're a bad person, I think, ultimately. But it's pretty serious. And it's criminal in some cases, right? There's go-to-jail consequences. So just, I hate to say that at the end of my talk, because my goal of my talk was to say...
I'm not trying to scare you.
My goal of my talk was to say you can handle this, really. So I want to revisit what I said before, which is like, if you're a bad actor, you know you're a bad actor. This is never ambiguous if you're committing fraud, I promise. If you're listening to this conversation and talking to me right now, you know enough information not to commit fraud.
Yeah, most likely, if you're in that position where you're committing fraud, the IRS is the last of your concerns. It's more likely going to be the Department of Justice. They're coming, people are knocking down your doors. You'll never most likely meet your IRS auditor. You never meet them. You have to fight to get a phone call, actually. Most of the time they'll talk to you over fax. They don't even do emails. It's a lot of fun. It's like going back to the 70s. It's great. So again, making that good faith effort, making sure you track your transactions. If you can't find out if the wallet didn't exist, that information's not available, try. Make an effort. Okay, I bought it on the 11th of March and on this year. What was it trading at on the most openly available exchange? Google it. What was the #1 hit that was a cryptocurrency exchange? That's a good faith effort. You try to report it right, and if ever you're concerned, talk to a tax professional. We're generally fun people. We have to deal with an interesting code that is more ancient, venerable, and maddening than most code out there. So our code is written by Congress, and we've already discovered how crazy they are. So they're a fun group of people. Working on the Hill, they drink pretty heavily. But it's always make sure to reach out, ask questions, and do your best to comply. If you're ever in concern, ask. There's plenty of information out there.
Just to circle back to the point I was making at the beginning, please watch Tyson or listen to Tyson and Jason's podcast. Have you heard it?
Yeah, I did.
Yeah, okay.
That was my lunch date.
And the link for that is in the Meetup page for this event. If you're watching the live stream, the link is in the description.
And they're much more concise than I am. It's so good. All right. Well, thank you very much for your time and attention.
Yeah, the live stream, if you go on the Meetup page, it's the YouTube link. And it'll be available until I delete it.
Exchange questions. It wasn't as fast as I was expecting, though.
Oh my God. Thank you everybody for coming out. There's still some more here, and I think there's some more out there. Take care.
The golden passport. Okay, yeah. I've heard of the golden passport.
Say you're a hypothetical
well, you don't have to speak hypothetical.
Absolutely. I'm going to do these things more often.
This is half of what I do. Literally, I wish you talked to me. No, it's okay. I didn't want to step on toes. Well, we got together. The lawyers tend to be in a more aggressive position. The lawyer never signs your tax return.
You seem to sign it.
Yeah, I do more individual because they sign. Yeah, I'll get this is easy. Yeah, so I work for a tax preparation company. We do tax. Or you got I have plenty. Oh, okay. I didn't want to steal all. No, so we do individual taxes.
Travis, do you want me to wait until everyone leaves?
No, he has